Weekly. It is episode 67. We're here with you on the second Thursday of March, the 10th today. We have an awesome video for you guys to continue credit month, and joined with us as always is Joe Bladek. Joe, how are you doing today?
I'm not too bad. I'm really excited about credit month. Yes, March credit month, and glad to be here today. The weather seems to be getting warmer as well. We were just talking about spring, and yeah, I'm really excited about just the new season and just talking about credit month today. How about you?
Yeah, I think it's going to be an awesome video and lots of great topics that we get to talk about over the next few weeks. I mean, last week was awesome with Ruth Ann. She shared a lot of good points, and yeah, definitely the weather has been nice. I can see almost half of my backyard now, which is, you know, a nice change of pace to see some of that grass rather than just a mountain of snow.
You bet. Yes, it was great having Ruth Ann on last night. You're right. Last week, she brought a lot of value and shared a lot of information about the Windsor market and just about, you know, a little bit about how to get into the market when rates do change and how to use that to your advantage. I remember her bringing up a good point about how when the market does have a rate shift, that there's a lot of opportunity for buyers to get in while the market is a little bit nervous. But yeah, the weather is shifting. You're right about that. And very happy that as I'm going for walks outside, it's just getting warmer. I feel like sometimes I don't even need to wear a scarf anymore or get rid of the hat, you know, that kind of thing. And that's always encouraging.
Yeah, that's right. We're in the stage where we're, you know, shedding layers, you know, day by day. I mean, I know that there's going to be probably at least one more nice ice storm or one more blast of winter before we're out of the out of the woods, but enjoying it while we can.
Yeah, I think this might be the second fake spring that we're having right now before the third fake spring, and then it will be the real spring. So yeah, and if anyone wants to challenge me on that, feel free. But yeah, just getting into things here on Canadian Mortgage Weekly. Sam and I like to go over the stats about what's happening in the mortgage market, the real estate market. So Sam, I know you usually put that together for us today. So tell us about what's happening with the bond yield today. I know we've been seeing a lot of action on the bond yield. So tell us what's going on.
Yeah, I mean, we have seen quite a interesting turn of events for the bond yield. We were riding pretty high, you know, at the 1.7% range, you know, give or take, you know, a few points, but then had seen it drop quite drastically, I think towards the end of last week. And this week we've just seen it, you know, play within a range. The bond yield is currently at 1.7, so it's still up from what we reported last week of 1.62. But again, you can see that it, as much as there has been turbulence, it hasn't really broken lower than, you know, 1.4, and hasn't really seemed to get back to where it was before that initial drop. So it seems to have found a new range that it's kind of bouncing between. So it's definitely interesting to see where it'll go from here.
It is really interesting to see where it will go from here, and it seems like it's that tightening range now. But you know, just seeing the fact that we're approaching that high again that we were at just a few weeks ago, I'm not sure if we're going to hit it, but it will. Time will tell, and we'll keep an eye on it on Canadian Mortgage Weekly here. But as we like to make note, we watch this specific target here because it's relation to 5-year fixed mortgages. Yeah, and you probably all know that the Bank of Canada releases its rate 8 times a year. Well, that affects variable rate mortgages. So on Canadian Mortgage Weekly, as we follow this, we're able to help our homeowners and home buyers just with fixed rate mortgages and help direct and advise them as to which way they should go. So with this one, Sam, I don't know, we could see a reduction in fixed rates if this continues to trend south, but we'll see.
Yeah, that's right. I mean, we did see fixed rates lower a little bit. They're slowly climbing back up to where they were. We're in that, you know, just over the 3% mark typically for a 5-year fixed. But yeah, it'll be interesting to track, you know, where it does go from here.
You bet. So the next metric we like to follow here, Sam, you got the CDOR rate. And as for this one, we like to also make sure we are calculating the difference between the current CDOR rate and prime rate and the variance between the two. So right now that's under 2%, which is good. And also that the rate has continued to slowly increase from 0.57, which was just 1 month ago. So even though it has been increasing, it still indicates here that variable mortgages are still a viable option. And we're seeing the spread actually quite large still between the current variable and the current fixed mortgage.
Yeah, absolutely. I think it's definitely still a viable option to be in that variable rate. It has been increasing, but it has been increasing slowly. And again, I think that increase to prime with the Bank of Canada's announcement has, helps the CDOR rate, um, show to us, yeah, that it's still a good option to stay on that variable rate. And speaking of the Bank of Canada rate announcement, last week was exciting because we had seen the first rate increase from the Bank of Canada for almost 3.5 years, which is quite a fact to get your head around, especially if you're a variable mortgage owner, because we hadn't seen rates raise since October of 2018, and it hadn't changed at all since March of 2020. So if you had purchased a home in the last 2 years, you haven't seen your rate change at all if you were able to purchase on that variable rate.
That's right. If you purchased on a variable rate, you've been paying off a lot more principal than everyone in a fixed rate currently. So definitely have been able to get a little bit of a head that way. But yes, it's not a big scary thing. The fact the rate has gone up by a quarter point in the 3.5 years, that's still a very small jump. And to get to the current fixed rate, I think, Sam, we're looking at 6 quarter point jumps to get to the current fixed rate. So I know we got that next announcement on April the 13th. So we'll make sure we'll have a big, exciting announcement for that. That's just before Easter. So great way to start the week.
Yeah, that's right.
All right. So with the next thing we like to report here, that's the national price average. Really looking forward to the official numbers here on that will be coming out in just a few more days here. We'll have those numbers next week on Canadian Mortgage Weekly. But we have seen some repricing of listings in the last few weeks. I've seen realtors come on, talk about how all of a sudden things are changing, listings are hitting the market. Sam, that could have an impact on the national house price.
Yeah, it could. I mean, I know that we have, seen a bit of increase in inventory. The market seems to be picking up a bit. I know that, we have seen, and if you look at the chart, it has a couple peaks and valleys, but that gradual trend line is still, increasing slowly but surely, with a huge increase from January 2021 to 2022. But yeah, it'll be interesting to see what the new data shows as we ended off February, just to see, if it's able to sustain that increase that we've been seeing month over month, or, if we'll start to see it soften out, or something's got to give, right?
We'll see what what the numbers say, but you are correct. We do see peaks and valleys. So usually when we do have a peak, it's followed by a valley before the next peak. So we kind of need those peaks and valleys to have those peaks. So that's a tongue twister right there. So we'll have that information for all you viewers next week as we report it here on Canadian Mortgage Weekly. But still exciting to see the new listings because we do need some more supply. So it'll be interesting to see what happens, how people shift and move this year into the spring market. And with that, I want to introduce our main topic for today, and that is the 5 things you can do to improve your credit score today. And Sam, there's a lot of good tips in here. And if anyone's watching right now, grab a pen, write these tips down. It's going to be really good to just put these into action as soon as possible. These are tips that, Sam, people can just take advantage of and start using them today, and their credit score should increase from being able to use these tips.
Yeah, that's right. I think that there is a lot of a lot that people don't necessarily know about their credit score, how it's calculated, some tips to get ahead of it. I think, just kind of the standard baseline information for everybody is to make payments on time, make sure you're at least paying that minimum balance that's owing. But there are some tricks to help you actually increase your score. And exactly like you're saying, there are things that you can start implementing today. So it's really exciting to be able to kick off credit month by showing you guys some ways to really actively, take control of your credit score and start building it.
It really is. With that, our first tip that we have, and it's something that, a lot of people, once they realize, they're like, oh yeah, that makes sense. But it's keeping your utilization ratio down. And what that is, in just so we can all understand, it's just how much you're borrowing compared to your limit. So an example that I love to use is the comparison of someone having a $100 balance. $100 balance on a $1,000 card versus a $100 balance on a $10,000 card. Now, $100 on a $1,000 limit card is 10%, but $100 on a $10,000 limit card, that's 1%. So your utilization ratio will go much lower the higher limit you have. So that's one way to look at it there. And if it's possible, do keep your utilization ratio less than 50%, and that's per account. So say if you have credit card A and credit card B, it's good to keep both ratios under 50%. Don't just load it all up on one card, because having a ratio that's less than 50% will help your score stay in that high range.
And that's probably one of the biggest portions of what goes into calculating your credit score. And I know that we have seen, some cases where we've seen some negative credit, and then we find that, a couple cards maybe are dipping into the overdraft a little bit, or they're sitting really close to that limit. So it's not always easy to stay under that 50% utilization ratio. But I mean, I know usually every few months my bank offers me a limit increase. So you can take that to your advantage, accept the limit increase, and thank the bank for helping you build your credit score a bit faster.
Yeah, that's a good tip there, Sam. Just by increasing your limit, your utilization ratio will go down, and it is in effect raising your score that much more. So great point there. And so always take a limit increase if possible. The only way I wouldn't recommend taking a limit increase is if you don't really think that you'll be able to restrain yourself from using it improperly, I guess. So always use credit responsibly if you are using credit. The second tip that you can take advantage of today, and Sam, that's the statement date versus the due date. So that's a big deal in terms of how the lenders see your credit card accounts. I know we talk to a lot of people that come to us and say, oh, Joe, we have no debt. We pay off our credit cards by the due date every month. But how does the lender see that?
Yeah, well, I mean, the lender, so when your credit score is calculated, they go off of the most recent statement date. So if you're still carrying a balance on that statement date, that's going to be reflected on what the lender is going to see. It's going to be reflected in your credit bureau. So sometimes, like you're saying, in those conversations where clients are telling us they pay everything off every month by the due date, sometimes we'll actually see a balance still in there and end up having to confirm with them, has this been paid out? Is this part of what gets covered? So by paying it a little bit earlier before the statement date, it'll actually carry over and show on your bureau and to the lender that $0 balance. And we actually just did a video on this, which covered it in great detail. So if you're interested at all about, learning more about, how to increase your score, how to help yourself out, and just to know what the difference is really between statement and due date, we do have an awesome topic video for you to check out.
Sam, thanks for reminding me about that topic video that we did. Check out our YouTube channel to see that video. But yes, you're absolutely right. If the debt's not paid by the statement date, it's actually considered still a debt, not paid off every month. Even though the client may pay it off by the due date, it needs paid off by the statement date. So definitely check into your credit card providers as to when your statement date is, and make that a note on your calendars to make sure that when you are paying off your credit card, try to do it by the statement date and not by the due date. Now, another credit tip, number 3, Sam, out of 5, really pumped about this one because it's something someone can do pretty easily online, or in the store, possibly, if you're doing that, or if stores are offering this still with COVID, but is increasing the number and type of accounts that the person has with credit. So, if you have a MasterCard or a Visa, maybe get the other one, MasterCard or the Visa, right? So you have a MasterCard and a Visa, or if you have already a few credit cards, maybe you can get a line of credit to differentiate and show different accounts. And Sam, there's other ways that people can show credit as well on their credit bureau.
Yeah, I mean, I know that I don't think I've done a single deal where someone hasn't had at least one car loan on their application.
That's right.
And that counts as a credit line. And again, there's the difference between, a revolving credit account where, as well as installment, where you're making those payments. And that's another thing, that by having, multiple accounts, it just communicates to the lender and to, the credit bureau that you are financially stable, that you can juggle multiple different accounts. I know that some people maybe put everything in one basket, and that's still good if you have maybe one card and you're paying that off by the statement date, your utilization ratio is good. But if you do want to maximize it, adding an extra credit line can really help you to do that.
Yeah, definitely. So that's number 3, and thanks, Sam, for that. We're almost getting to the end of this here, everyone. Don't get too excited. Number 4 is credit history. So, in this case, we talked about how the utilization ratio is the number 1 factor in determining your credit score. And that's right, Sam. But this one is another big factor in determining your credit score. And this is your older accounts that you're keeping open, and those accounts that you've had for many years that are showing good credit. That is all contributing a big part of your credit score, the past history you've provided. And that is only going to stay on your credit so long as those credit cards remain active. So one thing we suggest, Sam, is not to close any old accounts that you've had for years. Just keep them open so we can make sure that you have a good credit score and you keep your credit score as high as possible.
Yeah, exactly. They love to look, especially with COVID and coming off of Christmas, where maybe there's some credit issues. They love to see those accounts in good standing, and they like to see lots of months being reported. So if you have an old account that you had from college or university, but maybe you even forgot about it, that's almost a good thing, because you might have even noticed it if you do have a auto loan or some form of a loan. When you fully pay off the account, you might even see your credit score dip a little bit. It will likely restabilize, but that initial dip is just because that account is being closed and you're losing the credit history associated with the repayment of that loan or that credit account.
Good point, Sam. So definitely, if you have any questions about that one, it can be quite specific in possibly your scenario. So talk to one of us to get a better idea of how closing an account may affect you. Something to also make sure that you do is don't have accounts closed on you. Make sure that you close them, because that's also a big reporting factor, and that's almost like a 4B. So don't get the accounts closed on you either with like inactive history. I had one actually recently, Sam. It was a credit card where I hadn't used it, and they said, if you don't use this credit card by this certain date, we will cancel it. So
wow.
Just to keep it open, you need to make a transaction once in a while. Number 5. So the last credit tip of the day here, everyone, something you can really put into action today, that will be to actually do less of credit inquiries, right, Sam? And that would be to limit the amount of people that check your credit. Only do that in the absolute case where you want to move forward with some sort of financial instrument of any kind, but only at that point. So Sam, limiting the amount of inquiries, that is something that we see a lot of when we pull a credit file on our end. We'll see how many credit inquiries this client has had in the past 24 to 48 months. And sometimes it can be quite a long list.
That's right. I mean, and the scary thing is it can sneak up on you if you're not aware that, you know, each of them is a hard check and is you know, reported and recorded on your credit bureau. I know we've looked at some where, you know, even when they were looking to get the car loan that, you know, they have, we can see 2 or 3 different, you know, auto dealers that were looking at their credit over the period of, you know, a few months. And it really doesn't communicate the best story to the lender when they see that, you know, there's already been 4 different banks looking at your information to see if you can qualify for a mortgage. So a best step is to, again, like you're saying, limit the amount of people that are actually looking at your account. And I think that's, you know, one of those strong benefits of using a mortgage broker is we can use the one single hard credit check across all of the lenders and banks that we work with. So we do, in essence, protect that score and limit it to, you know, just the one check rather than, you know, if we're going to run your scenario by 5 banks, we don't want to have 5 individual credit checks, but we can do it all for you on the one.
Great, Sam. That's a great point. And great point also about talking to a mortgage broker. Talking to someone like that, a mortgage professional, can really give you some options and provide you with some knowledge before even getting a credit check. We can help pre-qualify you and get some numbers to you just based on some of the information we ask for instead of the credit check. So definitely give Sam and I a call if you're looking to get that set up. And speaking about Sam, Sam's a mortgage professional that lives in the Bay Area. And just a little bit more about him, because he's been on the show for quite some time now, 67 episodes.
Yeah.
You've been with the team for 2 years and originally moved from Ottawa. So it's always great to have you on the show today, Sam.
Yeah, thanks for having me on the show. It was a lot of great information. I'm happy that we could chat about this. And for anybody who doesn't know Joe, Joe is a mortgage broker up in the Barrie, Aurelia area, living there with his wife and 2 kids in the industry for over 11 years. So thank you, Joe, for being on the show and sharing some of your insight and expertise in the industry.
Thanks very much, Sam. And also thank you to all of you today joining us on Canadian Mortgage Weekly. We invite you to join us next week for episode 68 on Canadian Mortgage Weekly, Canada's weekly video mortgage news podcast, as we will be talking about the 3 ways hot water and furnace and air conditioner rental contracts can impact your credit score. You won't want to miss this one. Sam, we've seen a few of these and how they've come up on client files.
That's right. You definitely want to get ahead of some of these issues. So it's going to be a great episode and a lot of details that you're not going to want to miss.
All right. Thanks very much again, Sam. And thanks everyone for watching. Follow, like, comment, or share our video, and we'll see you next time.